Ladies and gentlemen, hello, this is Christopher Aaron. It's the 21st of September 2016. This is the broadcast coming to you on the Wednesday after the Fed meeting. Some very interesting market action today after, once again, another no change in interest rate policy. But there was a difference in the language that the Fed used today. So we will take a look at that. It does indicate a strong chance of a rate hike later this year and what the consequences of that will be. Thank you for joining me. So just to start off here briefly, let's look at the action today and over the last few days in gold and silver. A nice move higher today in gold after holding the bottom that we were watching last week above 1305. So a nice move higher today. I am looking to see if this will be the next challenge on the long-term downtrend line that we've been watching for months here on this channel. We will see if that happens within the next day or so. Typically, based on my experience, when you see the gold market move like this into the close, and especially in the access hours here in the New York Globex market, the electronic market, when you see continuous spikes like that in that market, it indicates that there's some pent-up buying that is going to continue through Asia, and that if that sets off some buy stops as we come into London or New York tomorrow, we will have a continuation move. So a very strong possibility that we might see another retest of the important trend line we've been watching, which comes in between 1355 and 1378 right now. We could see that as close as tomorrow. Silver, an even stronger day today. Now, if you were watching in the overnight hours, this was very interesting, and it bears some discussion because we saw silver starting to move in the overnight hours in Asia before a Fed meeting. This is very rare. Typically, before a Fed meeting, you will not see any significant moves such as this because most traders are waiting to try to interpret the Fed language because the trading can get so volatile after the actual announcements. What we saw yesterday was silver try to take off, hit 1930, get smashed back down to about 1910 within the course of 2 or 3 minutes in the Hong Kong trading. And then we saw it come right back and more so then establish sort of a basing pattern here until trading started opening in New York when it just took off again. So what you had was, this looks to me, the best way that I can interpret this is you had some serious position trading going on here. You had people coming into the silver market in the overnight hours saying, we're not concerned with what the Fed is going to say, yes or no, higher or lower for interest rates. We want to establish some serious long-term positions. That would be the only way that I could interpret a breakout like this in silver in the overnight hours before a Fed meeting, because traders are typically not brave enough to do that due to the volatility. So very interesting. This bears watching. The line in the sand that I'm watching for silver to tell me that the next significant move higher is underway. We're going to confirm that around 2025. So not too much higher than today. We could perhaps see that tomorrow or later this week. And then I think we're setting up for a significant move higher through the fall. Now, looking at the reaction post-Fed and what they actually discussed at the meeting. So the major points were this. There was no change to the interest rate policy. The target rate is staying between 0.25 and 0.5%. That said, they did strongly hint that there would be a rate hike coming later this year as long as the stock market doesn't fall apart. And basically, I mean, this is kind of humorous because officially the Fed will say that they do not respond to the markets themselves, but they're trying to stay as nonpartisan as possible. But we all know, if you watch the Fed, how they actually behave for years, year in and year out, you will see that they almost always tend to cut rates when the market is going down, and they will very rarely raise rates when the market is going down. So if the market stays stable here, the stock market that is, for the next several weeks into December, I would say there is a strong chance that they will raise the interest rates again, probably by 0.25%. And the final thing is the Fed, Janet Yellen really spoke about this 2% inflation target per year, that the Fed is really working hard to try to get inflation to this 2% level. And the absolute lunacy of what has been passed as mainstream analysis, that this is somehow a healthy thing to have 2% of the currency losing value every year, year in and year out. It is absolutely unprecedented to have a central bank explicitly stating this. And mind you, you have 10-year bonds, as we've been talking about over the last year. You have 10-year U.S. bonds that are yielding only 1.6%. So here the Fed is saying that their policy is to rob the billions and billions of bondholders holding 10-year notes. The policy is to steal, at this rate, 0.4% from them per year, or the difference between this target and the 10-year yield. So it's really unprecedented what we're living through here, guys. And if you are just starting to follow these markets, know that you are living through the later stages of what is an unprecedented experiment here. And this, if we can learn anything from the past, will resolve in some sort of a return to gold to some extent or another. This does not mean we will all be trading gold coins and using silver pieces to buy our groceries, but we are expecting a significant revaluation higher in the metals and somehow a return to some sort of a standard that uses at least a portion of gold in the currency, because this has just gotten way, way, way too insane. Now, we are looking here at the long term for the Fed interest rate policy. And if you can see, Fed interest rates here being held at the lowest they have ever been, and not just for a brief blip like this, like happened in the 50s and the early 60s, but for 9 years. So keep in mind, the first interest rate hike that we saw in 9 years occurred last December. And let us look at the action after the announcement today. Once again, this was not an announcement of a rate hike, but it was basically the announcement of a rate hike coming in December. So close to an announcement of a rate hike. And what happened here to our various major 6 world asset classes? Leading the way out of all the sectors in the world, all the major sectors, we had what? The gold stocks rising 7% today. Behind that, silver rising over 3%, gold at 1.5%. The rest of the U.S. stock market barely above 1%. Bonds rallying less than 1%, and the dollar falling. So you're not hearing this on the mainstream news. You know, you will hear the headline, the Dow Jones rose today by a little over 1%. You may hear a notice of the 10-year or the 20-year bond, but you are not hearing anything about the outperformance that is happening now in gold and silver, and mind you, and in gold stocks. And mind you, this is happening when the mainstream media will tell you that rate hikes are bad for gold. If you've been following this analysis, you know that it is exactly the opposite of that to be the truth. Let's look at the action since the first Fed rate hike in 9 years. We showed that on 2 slides ago for those same asset classes. If rate hikes are bad for precious metals, then I'll take some more pain, because this is by far one of the most clear demonstrations that you can see that gold, silver, and gold stocks, since the day, and we are rebalancing everything from a zero scale here, that the leading asset classes have been precious metals since the Fed announced their first rate hike. And that was supposed to be positive for the dollar. Well, the dollar is lower since the first Fed rate hike. These trends are going to be continuing. Now, how did we know? If you go back and watch some of the videos from the beginning of this channel, some of the analysis that I've been doing for the site that I'm a partner at, Gold Eagle, and if you go back and watch some of the early videos, some of the articles that I was publishing this time last year, before any of this outperformance happened across the gold stocks, how is it that we had some sort of a sense that this was setting up when most of the commentators were telling you the Fed's getting ready to raise interest rates, it's going to be bad for the precious metals? How did we know? And if there's one thing that I would say, if you are a student of the markets and you want to sort of learn some forms of technical analysis for yourself, which, as you know, is what I focus on because it's what has worked for me over the past, this is one of the most powerful things that I think you can study and practice, which is looking at this one very simple concept. Now, we've looked at this chart in the past. I'm bringing this up for two reasons. One is to remind people what is still possible here with this sector, because there is a lot of fear in the gold and silver sector right now, and especially in the gold and silver mining sector. I see this quite often when I see comments and people posting, not just on my channels, but other channels, various articles. A lot of people are very fearful of the action in the gold stocks right now. And this is exactly perfect. This is what you want to see. When there's a healthy level of fear, it typically means you're nowhere near a top. So what we are looking at here is the ratio of the gold stocks, the XAU index, to the S&P 500. In other words, the gold stocks as a percentage of the overall U.S. stock market. So how did we know that these gold stocks had bottomed last year before this major rise that we've seen? It was this. We're looking at a ratio between real asset classes. Now, real asset classes, what do we mean by that? We mean gold stocks and the broad U.S. economy. Both of these are real assets. Both of these cannot go to zero. Gold stocks, these are the companies that mine metal out of the ground, and they're sitting on millions of ounces of metal. Every piece of gold or silver that you have sitting in a safe or on your desk to play with, as I do, having a few coins laying out here, any of these coins that you have are being mined by these gold miners. So they're intrinsically related. The S&P 500, even if the stock market crashes, has some intrinsic value to it. A lot of these companies own a lot of land. A lot of them own a lot of agriculture. They own water. They own oil, natural gas, electricity. All of these things, even if the market crashes, will always have some value. Now, what happened here that we knew that this bottom was coming was you had the ratio between two real asset classes approaching zero. In other words, you had the value of one thing that cannot go to zero divided by the other thing that cannot go to zero. You had that ratio getting the closest to zero that it had ever been in the history of this data. So when something happens like that, you had this ratio get down to 0.02, and it was falling at 0.02 per year for the last few years. This was an unsustainable fall, and basically if that had kept going, it would have meant every gold mining company in the world was going to be bankrupt by 2017. And that was an impossibility. So when you are watching a ratio move in a direction that is an impossibility, it's usually a pretty good time to start buying that. Okay, the gold stocks cannot go to zero, and the S&P 500 cannot go to zero. So if you can focus on this one general principle of looking for real asset ratios that are approaching zero, you can invest based on this one principle basically for the rest of your life. And this goes way beyond gold stocks. And there's a lot of individual ratios like this that will go through these wild fluctuations through time. It just so happens to be that gold stocks were the ones that did this most recently in 2015, 2016. So, mind you, even as the GDX or the S&P, the GDX or the XAU gold stocks we've seen have risen over 100% since that first rate hike, that 100% only takes the ratio from 0.25 to just below 0.05, actually closing at 0.046 today. So that entire move that we've seen is right here. You have not missed, if you are only becoming interested in this at the first time, you have not missed the move that is coming in the precious metals, and especially in the precious metals equities. This ratio needs to gain 2,000% still to reach the level that it reached at the previous long-term peak, which happened in 1980. That was a fairly obvious bubble that formed in the precious metals. We are nowhere near that now. So, do I sell research related to this sector? Absolutely. Why? Because this is what I'm invested in personally. This is what I'm invested in through my firm for clients. And this is the research that I publish because this is the data and because I believe in the data. So that's why I'm doing this. There is still a lot of opportunity here to come, but mind you, as we've seen over the last few weeks, it is going to be very volatile, and you're going to have 20 to 30% corrections in each company that you own every few months. The volatility is really crazy. The summary, we're watching these support and resistance levels in gold, 1285 to 1306. This came out wrong here. This did not print right. We're watching the long-term resistance, which I said before was 1355 to 1378. We are looking for support still holding between 1750 and 1850 in silver. Watching the resistance between 2025 is this first level that I want to see that's going to tell me silver is ready to make its next surge higher. And there's plenty of upside still when considering the long-term valuations in the gold stocks. Keep in mind, sometimes these things act like gold and sometimes they act like stocks. So they are like a bipolar asset class here that can frustrate you at just the worst time before they get ready to take off to the upside. You always have to keep this facet of gold stocks in mind if you're considering making investments in that sector. I thank you for watching. The next update will be a week from today. And I just wanted to leave you with this. This is one of my favorite quotes from Tolkien. Not all those who wander are lost. And if you've made it this far where you're really understanding the precious metals and tuning into this market action, you clearly have done some wandering over the last few years, because this is not what is being discussed in the mainstream media. But I would say that you are probably also not lost. Thank you once again, and I will see you this time next week.